there's no free lunch in Bitcoin, right? There's no risk-free rate. What is a risk-free rate in Bitcoin? There's no lender of last resort. If you lend out your money to someone, they're taking that Bitcoin, they're rehypothecating it, they're lending it out to someone else who lends it out to someone else, and then it ends up, and then Luna, and then that person invests in Luna, and Luna collapses, and then, it's a cascading effect, which is what we saw last year. And so that's kind of the principle that we take, which is that, there is no, at the end of the day, there is no free lunch. And so what we're building is the ability for folks to be able to make a return on their Bitcoin. So that's obviously using trading strategies. And right now, the trading strategy, we've gone out and we've spent the time to be able to develop the trading strategy, and we automate the process for users. But that doesn't mean there's no chance that a loss will occur. You could lose 2%, you could lose 4%. But obviously, what we're aiming for is to build a passive way of investing that allows for you to make returns on your Bitcoin over a longer period of time.
Hey everybody, welcome back to the Blockware Intelligence Podcast. This week I have on Tony and Matt from AtomicFinance. Guys, welcome.
Thanks for having us, Joe. Great to be here.
Absolutely. Great to have you guys. I want to dive right into it. So Tony, I know you originally became interested in Ethereum and then you became a Bitcoiner. Matt, I'm unsure if you had a similar experience getting into the space, but can you both dive into how you became interested in this space and then how you recognized Bitcoin was the innovation you were interested in?
Yeah, absolutely. It was actually funny. I think it was myself that got Tony into the space originally. So I actually originally got into the space back in 2014. My dad's a bit of a gold bug, and so he's just looking for whatever kind of currency. Doesn't want to trust the government, so he likes gold, likes silver. And obviously Bitcoin was definitely on that list. And so that's how I originally got introduced. I honestly forgot about it for a couple of years. 2014 went by, then we're in 2017. Myself and Tony we're both roommates actually at the University of Waterloo. And in Waterloo, there was a lot of kind of Ethereum community, events going on. There's, hackathons happening. And so we actually really got introduced to the Ethereum community and what was being built there at the time. And so, I was saying to Tony, hey, you should buy some Bitcoin, buy some Ethereum. And we got really interested at the time in what was happening specifically in the DeFi space. Just the idea of being able to actually be able to create financial tools that are accessible anywhere on the internet. Anyone with an internet connection can access it, without having to have a specific bank account or be in a specific jurisdiction. That was just really fascinating to us. And so we actually we both started working at Consensus at the time. And I was working on actually atomic swaps between Bitcoin and Ethereum. Tony was working at OpenLaw. But it's in that time, shout out to L'Equality, because they're the ones that actually really got me into Bitcoin even more. There were some Bitcoin maxis on the team, and they really instilled the idea that, hey, this is why the properties of Bitcoin are so important. The idea of a hard supply cap, the idea of being able to, to have a decentralized currency that, no one has central control of and can change very easily, is incredibly important. And so, that's really what got us down the rabbit hole. From then we started kind of experimenting and building different tools. And that's what eventually led us towards what we're building now. Yeah.
Awesome. I like it. Tony, do you have any background for use in particular?
Yeah, I think Matt covered most of it. Two of us, we were roommates in college, and basically he got me buying my first little bit of Bitcoin on Coinbase back in the day. I think it was in 2017. And then just kind of got more and more interested in it, read more about, dived into the ETH side of things first, initially, like Matt said. And then kind of just after reading the Bitcoin Standard, after kind of diving into a bunch of books on the Bitcoin side, that was where it kind of clicked for me. And the importance of maybe Bitcoin's the real innovation here. Maybe it makes sense to just kind of focus on Bitcoin and building tools on top of Bitcoin. Building on a more sound foundation is ultimately what's going to help us be along for the long run as well. And so that's kind of how we slowly made the shift from Ethereum to Bitcoin and where we are today.
Yeah, I like it. I kind of want to get more into Bitcoin and Ethereum. Like, how has Bitcoin and Ethereum evolved over the last 3 years when you guys kind of made the switch from originally being interested in Ethereum and now being interested in Bitcoin?
Yeah, that's a great question. Well, I think the most obvious one is Ethereum switched to proof of stake, and so at the time we were, there was a lot of discussion around proof of stake when we were still in Ethereum, and kind of this idea that it was eventually going to make the switch. And I think we really weren't happy in general with the way decisions were made in Ethereum. Generally, kind of the idea of a hard fork occurring every X amount of time in Ethereum has become a bit of a standard, and that always seemed concerning to me, and I think to Tony as well. And so in that time, obviously, we've seen Ethereum finally transition, and we've seen, really the Ethereum space, instead of being secured by miners, it's now secured by exchanges. And so that's happened. In the meantime, I guess we've had, one change on Bitcoin, which is Taproot, which obviously has had its positives and negatives. We can talk about ordinals later. But, in general, kind of Bitcoin has stayed mostly the same and has stayed the kind of secure and decentralized network that it is. And Ethereum has moved kind of in the other direction. I don't know, anything to add, Tony?
No, I think you hit on it. Yeah.
Yeah, I mean, I think that was very well said. It's definitely like when I think about Bitcoin, when I think about Ethereum, I think about Bitcoin being the least uncertain asset. With Ethereum, like you mentioned, there's constant hard forks of changing, the future supply. Now the future supply, I guess, is dependent on how many people mint and trade monkey JPEGs. So there's definitely a lot of uncertainty around ETH, and there's a lot of there's a lack of uncertainty around future uncertainty around Bitcoin, I would say. I do want to dive into what you guys are building, though. You guys are co-founders of AtomicFinance, and I'm curious, what is AtomicFinance, and how does it compare to things like BlockFi, FTX, and Celsius?
Yeah, so very simply, AtomicFinance is a mobile app that allows you to get access to financial tools for Bitcoin without having to give up custody of that Bitcoin. What we like to call it is sound finance for sound money. Basically, financial tools that are no nonsense. They're as transparent, as verifiable, and self-sovereign as Bitcoin itself. And basically, the first of these products are a simple solution for folks to earn a return on their Bitcoin stack, again, without giving up custody to a third party. And as many of us in the Bitcoin space knows, especially from the past year, what happened in 2022, if we want to really do anything financial with our Bitcoin, whether it's to earn a return on it, whether it's to hedge price downside, etc., the only solution to do that kind of stuff is really things like the BlockFis of the world, the Celsiuses of the world, and FTX. And with those, as we all know these days, you're at risk of being rug pulled, right? They're centralized, they're opaque, they force you to give up full control of your of your coins to them, and a lot of the best properties of Bitcoin, in terms of its self-sovereign nature, in terms of its transparency, verifiability, they just go right out the door. They just get squandered whenever you want to do financial things with your Bitcoin. And so kind of like when we were starting to think about ideas in terms of what to build on top of Bitcoin, the question we asked ourselves was, is there a way to be able to do more with your Bitcoin while still being able to keep as many of the properties that make Bitcoin Bitcoin? And that's kind of how the whole moniker of sound finance for sound money came in. And in terms of how folks are able to actually earn a return on their Bitcoin without giving up custody, the way to really think about that is by breaking it down into two things. In terms of where the premiums are coming from, well, in our current version of the app, folks are engaging in simple and automated options-based strategies in order to earn a return and earn an income on their Bitcoin. And in terms of the second question, how is it non-custodial? I think Matt's going to dive into it a bit more later on in the podcast. But in essence, we use something called Discrete Log Contracts, or DLCs in short, which are basically, you can think of them as a very simple Bitcoin native primitive that you can use to encode certain types of financial instruments, whether that's a bet, whether that's a options contract, etc. And that's all in all what AtomicFinance is, and what we're trying to build. And longer term, the vision is to basically be able to build a one-stop shop financial ecosystem of sound financial tools in the long run, but starting right now with an ability to earn a return on their Bitcoin without giving up custody first.
Yeah, I mean, I think what you guys are building is really cool. I mean, in my mind, it's very difficult to outperform Bitcoin, and there's like maybe 3 things that I think are like viable to where you can outperform Bitcoin. Like one is Bitcoin, like venture capital, investing in early stage companies that are doing things in Bitcoin. And then 2 is mining. Obviously, we work at Blockware where our clients mine Bitcoin. And then 3 is something like what you guys are building, which is really cool. I know like right now the app is in beta. I've been using it for some time now. It's amazing. When do you guys think you're going to release it to the public?
Yeah, it's a good question. I think we tend to take a more cautious approach, and so basically like we've kind of been slow rolling it in terms of opening it up more slots for users on our wait list. And so right now we're a couple hundred users in, and we've kept limits kind of low in terms of like everyone can only invest up to 0.1 BTC. We recently just increased that to 1 BTC in the last week or so after seeing the infrastructure being battle tested after a couple months. So, no firm date just yet in terms of public launch, but I think, we're going to continue to expand the number of users and hopefully be able to move towards a public release towards, the second half of the year.
Awesome. Yeah, I know like the current main strategy that I think every user is using right now is like the covered call strategy. I think it's really cool. It's what I'm doing on the app. What other strategies do you guys think you may roll out, in the future?
Yeah, I think it's a good question. Like I think, one of the cool things about DLCs and the infrastructure that we're working with is that it's quite versatile, right? So basically, depending on what your market outlook is, depending on, what your risk tolerance is, there's the possibility of building out, a number of different kind of strategies meant for that risk profile, meant for that market outlook. And so, whether it's, you want to earn a return during a bear market, or you want to kind of hedge against price downside because you think another March 2020 is happening, strategies can be built out for those things as well. I think that, there's tons of possibilities, and we can't wait to kind of build out more. But, we're starting out simple with a cover call strategy and hoping to kind of develop more different kind of strategies for different markets moving forward.
Yeah, love it. I know a lot of people in like the crypto space and even Bitcoin space sometimes use the term like DeFi, decentralized finance. I've seen you guys use the term sound finance. Do you mind like defining these 2 terms? I know you guys use a little bit of a different terminology. Like what do they mean to you? And then like why did you choose to call it sound finance?
Yeah, that's a good question. I think, to be honest, we originally were terming it DeFi. DeFi, hey, we're building DeFi for Bitcoin. But we heard from a lot of Bitcoiners that they just really weren't happy with that term being used. In a certain sense, it seems that it's been tarnished to a certain extent with the amount of hacks that have occurred, with the number of kind of admin-controlled contracts that exist in Ethereum. And so, we wanted to kind of distance ourselves from that kind of existing ecosystem that existed. And obviously, kind of sound finance for sound money has a really nice ring to it. But I think really it's just about building, financial tools for Bitcoin that retain as many properties of Bitcoin as can possibly be done for financial tools. So I think that's really what sound finance is. No shitcoinery. Build it on Bitcoin. Build it on the base layer. By Bitcoiners for Bitcoiners.
Yeah, I think to me, like when I was thinking about that, at the end of the day, we're more interested in building out long-term sustainable infrastructure, financial infrastructure, and financial products that can stand the test of time. We're more interested in that than building a pump and dump scheme or like a yield farming scheme to juice up users early on, and then you're left with a token that doesn't do much and stuff like that. So that's why kind of like we wanted to really distinguish ourselves, I guess, from the pack in a sense, and not be confused with I guess what most folks typically associate with the term DeFi.
Yeah, absolutely. I mean, when I think of the crypto space, like, I don't like try to discount everything that I ever see. Like, sometimes like the technology is actually pretty cool, and in the past I've dove into various projects and I'm like, oh, this is cool, but like it's completely not sustainable. Like, if you really look into like what they're building, and it's like, this is insane. And yeah, people can speculate and gamble and hope NGU, the token number go up. But maybe that's like not actually going to last in the long run. So I'm curious, like, going off of this sound finance term, why do you think it's important, and why does it matter? Like, why should we build on Bitcoin?
Yeah, I think like when we were thinking about it, long term, the only way that Bitcoin's really going to succeed as a financial asset is if you can actually do finance with it, right? And the kind of the default path that we're on right now, anything financial, you have to do it on a platform that's centralized and opaque, right? And that's in essence like what a large driving force for why we're so we wake up every day wanting to build out kind of more sound financial infrastructure. In our view, that default path that we're on, it's one where, hey, like, sure, Bitcoin has those properties, has those self-sovereign properties when it stays in your cold storage. But the moment you want to kind of actually do something financial with it, they just go out the window. Well, that's not a really good kind of future that we like necessarily are looking forward to, right? Like, we want a future, if things succeed, we want a future where it's just a self-sovereign, or easy to remain self-sovereign and to keep things transparent, even when you're doing financial things with your Bitcoin rather than just holding it. And so that's why we kind of think the sound finance future is so important. We want to really prevent that kind of centralized financial future from happening. And we don't want to just a reincarnation of the existing financial system. And that's why sound finance is in our view, such an important future to fight for.
Yeah, I mean, I totally agree. I think it's a critical point. I'm curious, why do you think something like this hasn't been built already? Like, why does everything get built on other, like something like ETH or Solana or whatever? Why is it not built on Bitcoin? And then why is it, I guess, so hard to build things on top of Bitcoin?
Yeah, that's a good question. I think part of it has to do with, obviously, kind of what is the purpose of Bitcoin? The purpose of Bitcoin is to be censorship-resistant money. It's not to be JPEG land. It's not to be, smart contract galore. The purpose of Bitcoin is to be sound money. And so with that, obviously, if you go over to Ethereum and, your average JavaScript developer can go and deploy a smart contract and put it up in five minutes, and they can use all of this other infrastructure that exists for making that work. But all that infrastructure doesn't necessarily, exist necessarily for Bitcoin. And so for us, what we had to do to actually get things up and running was build a lot of that infrastructure ourselves from scratch. And so definitely the scripting language is definitely something that kind of holds things back. I think but at the same time, I think that's also an advantage, because if you look at, how generally things are built in Ethereum, you have one large smart contract that is pushed out. And then that becomes really a honeypot where other people, attackers can come in and they can try to steal the funds from there. Whereas in Bitcoin, you don't have kind of the advantage of being able to create this one smart contract and upgrade it and change it how you wish, but you have individual contracts for each user and each position that they're doing. And it's really, really, really difficult to be able to hack that. There's no central honeypot. And so you have this massive trade-off that exists. But I think, in the long term, if we're looking at what is the infrastructure that's going to survive the long term and that's not going to have hacks, and the one that's built on top of sound money, I think it's obviously, sound finance on Bitcoin.
Yeah, absolutely. I mean, I think those are some great points. What is your view, and this is going to kind of get into our next topic a little bit, but there's kind of like this idea of over the last year, we learned that like Bitcoin and yield are like somewhat incompatible. You can't just like put your Bitcoin in a box and earn 10% a year forever. As we learned, that's probably not, something's probably, you're missing something. There's actual risk there. So what is your view on people or users using AtomicFinance like passively versus actively? Like in my mind, maybe it's not really likely that you can just put your Bitcoin in a black box and not look at it for 10 years and all of a sudden your one Bitcoin is now worth like 5 Bitcoin. I don't know if that's possible. It'd be really cool if you could do that, but I don't know if it's possible. So how do you guys, envision people using AtomicFinance, whether the users are doing it actively or passively with different strategies that you guys roll out?
Yeah, I think that's a great question. Well, I think there's two aspects of that, which is number one, the conversation around yield, which is that I completely agree that yield has been dragged through the mud, and for good reason, right? We had BlockFi, we had Celsius, both blow up to a certain extent. I think our writer Craig, shout out to him. He coined a good term, which is you'll make 8%. You'll make 8% yield. You'll never enjoy on Bitcoin. You'll never see again, right? And that was the reality of those tools back, this past year. And so I think the reality, with any of these things is that there's no free lunch. There's no free lunch in Bitcoin, right? There's no risk-free rate. What is a risk-free rate in Bitcoin? There's no lender of last resort. If you lend out your money to someone, they're taking that Bitcoin, they're rehypothecating it, they're lending it out to someone else who lends it out to someone else, and then it ends up. And then Luna, and then that person invests in Luna, and Luna collapses, and then it's a cascading effect, which is what we saw last year. And so that's kind of the principle that we take, which is that there is no at the end of the day there is no free lunch. And so what we're building is the ability for folks to be able to make a return on their Bitcoin. So that's obviously using trading strategies. And right now, the trading strategy, we've gone out and we've spent the time to be able to develop the trading strategy, and we automate the process for users. But that doesn't mean there's no chance that a loss will occur. You could lose 2%, you could lose 4%. But obviously, what we're aiming for is to build a passive way of investing that allows for you to make returns on your Bitcoin over a longer period of time. If we're looking at the long term of AtomicFinance, definitely we want to allow for folks to be able to get access to those, to automated trading strategies. But in the future as well, we're planning to definitely add back the ability for people to do it manually, to be able to trade themselves. And so there's always going to be a balance there of giving people the tools to be able to do what fits best in their kind of portfolio and the risk that they want to take.
Foundation is one of my favorite Bitcoin companies. Their product Passport is one of the best Bitcoin hardware wallets on the market. It is air-gapped and highly secure. I strongly encourage you to go to foundationdevices.com and use the code BLOCKWARE and get $10 off your Passport. It's a great way to easily and securely store the private keys to your Bitcoin. Yeah, definitely. I think the covered call strategy that you guys have is very interesting because it basically enables you, hey, if Bitcoin doesn't soar in the short to intermediate term, you're going to be earning some sort of passive income off of just your Bitcoin in a very transparent way with your app. But then, if Bitcoin does soar, maybe I'll end up with slightly less Bitcoin, but like the real value of that Bitcoin is like magnitudes higher. So like I'm pretty happy making 10% in like a month or something like that. So I think it's a really interesting strategy, not necessarily to put, 100% of your Bitcoin in something like this, but to put a portion of your Bitcoin that you want to just generate yield off of or live off of.
Yeah, exactly. Well, I think you touch on a really important thing here, which is that don't put all your Bitcoin in this. Like have your Bitcoin in cold storage. But why is it that for the majority of the time right now that you go from cold storage, and the only alternative to cold storage, or a hot wallet is going and putting it on an exchange, right? Like there should be an in between. There should be, it shouldn't just be Bitcoin as a pet rock, as the altcoiners like to, shit on Bitcoin for. You should be able to do more with it without giving up all of your rights and, giving up complete custody of it. So I think that's a really good point.
Yeah, definitely. And like just for the audience, it's a similar way I think of mining. Like mining is a unique way to where you buy an actual machine that can convert, $1 of energy into $2 of Bitcoin. And it's like very core and native to the Bitcoin network. It's not like you're holding actual Bitcoin, you're holding a piece of hardware, but it's still like pretty native to the Bitcoin network, which is pretty cool. I do kind of want to get into like how you guys have built, AtomicFinance, and like I know Tony touched on it a little bit, but you mentioned DLCs. What exactly are DLCs?
Yeah, that's a great question. DLC stands for Discrete Log Contract, and essentially what it is, it's a smart contract on Bitcoin without the smart. It's a contract on Bitcoin that allows for you to really enter into a very simple contract between you, a counterparty, and the Oracle. Which essentially allows for you to get exposure to some type of financial tool. So that could be a bet, that could be an options contract, that could be a futures contract, whatever you want to do. And what's great about it is on chain, it actually just looks like a 2 of 2 multisig. And so, it's just kind of the same idea of Lightning. If you want to close out of this contract early, you just do an early close with your counterparty. Otherwise, upon expiry, the Oracle goes and kind of releases a signature, which allows you to close out of that 2 of 2 multisig. So, it's a really, really simple contract. There's, very limited risk. There's no risk of kind of smart contract hasks. And really the only thing you need to trust in the system is obviously the Oracle, because we need some type of outside data to be able to report on, what is the Bitcoin price or what was the outcome of this bet in order to be able to close out those contracts. But one of the really nice properties of DLCs is that the Oracle doesn't actually need to know about the existence of the contracts. And so you kind of have this Oracle that is blind, that can be blind in a sense, and just really reporting on the price, and then other people that are, making bets based on that information. So yeah.
Very cool. Are there like ideas that you guys have to minimize trust in the Oracle, like in the future? Like, can you theoretically have multiple oracles that like the DLC relies on, so you're not even trusting one exchange or one person, whoever the entity is that's updating the Oracle? Is there a way to trust multiple oracles?
Yeah, absolutely. If you check out the on the DLC like specification, there's actually like a specification for multi-oracle. And so we have plans to implement that down the line. You might set it up as like a 2 of 3 or 3 of 5 oracles. I think what we need to do in order to implement that in the app right now is just do some benchmarking around, because for all these signatures that you need to create X number of more signatures when there's multi-oracle. And so just making sure we can do that in a really great user experience is kind of the only thing holding us back from doing that right now. But definitely something we want to implement down the line.
Cool. Yeah, that'd be awesome. I kind of want to dive in. So DLCs are obviously like on chain, like that's one of the features of this technology. What happens, I guess, if we experience another like bull run and transaction fees spike, and all of a sudden, to enter this DLC, it's not, you can't just do 1 sat per virtual byte, which may be like a couple cents or 10 cents or whatever it might be, depending on the size of the transaction. But it could be $20, $50 if things get really crazy. Like, how do you think, does this scale if fees get high? And then if not, like, can this be pushed, I guess, to second layers of Bitcoin?
Yeah, absolutely. So I guess to address the first thing, which is that, if you have a case where fee rates rise significantly, even for on-chain transactions, if you're investing a significant amount, like say if you're investing 1 Bitcoin or even 0.1 Bitcoin or above, from our back testing, we've seen that that can still be profitable, and might eat into fees. Say if you're doing 0.1, like it might take 20% of your fees, for example, if you're going up to like 50 sats per V byte or even 100. And so there's still room. There's lots of room to grow, for the fee rate to grow, and for this still to be possible on chain. But at the same time, there's lots of development being done to allow for DLCs on second layers. I know that like Crypto Garage, shout out to Thibaut, and the Itchy Sats guys have been doing work on DLC channels. So that allows for essentially similar to how you would have a Lightning channel, you would have a DLC channel, which is, you enter into a channel with a counterparty, might be a market maker, for example, and then you're able to enter into a DLC and close it out without making any on-chain transaction. And so this can allow for obviously a lot of trades to occur without you having to settle on chain for a significant period of time. So, that could change, even for our model, you having to make an on-chain transaction once a month to maybe once every 3 months or once every 4 months. So definitely things coming down the pipeline. I think, to be honest, though, if you're looking at, say, DLCs on second layers, like a lot of people have talked about, DLCs on Lightning, for example. And this is going to happen once we have PTLC support, which came with Taproot, which is just a different way of sending the payments across the nodes. But so that will be possible. But the problem with DLCs over Lightning is when you enter that DLC, it has to lock up the capital throughout the entire route. And so I think what this is most likely going to look like is folks are going to enter into a channel with a market maker, and then it'll just be really easy to kind of settle these things off chain and then eventually on chain after a period of time. Yeah.
Huh. Very interesting. Kind of going off of that question, how do you think Bitcoin as a whole, or just very generically, scales long term? And the talk recently in action, I guess, around ordinals, has at least over the last month congested the mempool. Now the mempool is kind of chilling for a little bit, or at least last I looked. How does Bitcoin scale long term, and then how has ordinals affected what you guys are building, or has it?
Yeah, that's a great question. We were sitting here a couple weeks ago, and the mempool is rising. And we're like, oh, geez, is this going to affect our users? Because obviously, if users are doing like 0.1 Bitcoin and above, it's not a big deal. But we have lots of folks who are doing, say, like a trial amount, like they'll try out with a million sats, 0.01 Bitcoin, and so that does obviously it affects it because it's a lower amount. And so we saw the fee rates rising significantly, and then by the end of the month, when it was time for people to roll over, it was back to 2 sats per VByte. And so that that was interesting to see that I don't know, some people like to call it the ordinal attack didn't really affect things. But I think in general, like what's the underlying problem here? Okay, Bitcoin doesn't scale. Okay, but how does Bitcoin not scale? Well, there isn't enough space on chain. Like if we wanted to onboard 7 billion people to Bitcoin, everyone can't have their own private key. Okay, well, so I mean that's a problem unless you want everything to be custodial and the majority of Bitcoin to be held by custodians. And so how do you solve that? I think that's the $1 million question. And so I think like really it's like I think it's an interesting question because we've made some changes to Bitcoin. We've obviously had lots of improvements. SegWit enabled Lightning, and we've had Taproot come to the scene, and these things have really enabled for the second layer Lightning to really thrive. But even with Lightning, that doesn't solve the problem. And so where do we go from there? I think long term it's going to be a question of what changes can we make to Bitcoin that are really small, that don't change the incentives, that still allow for Bitcoin to scale. Lots of people have talked about drive chain. It seems to change the incentives significantly. Lots of folks have talked about multi-party channels in Lightning, which would allow for instead of lots of people would be able to settle within like one Lightning channel, and you would be able to have like many parties associated with it. And so maybe it's something of that nature where we can allow for Bitcoin to scale using a very small improvement. But to be honest, I don't know what that is. I mean, Joe, I'm curious from you. Like, what are your thoughts like on Bitcoin scaling and where we're at right now?
Yeah, I mean, like you said, I think you answered it fairly well. It's a complicated question, and it relates, I guess, to the block size war that kind of already played out somewhat. But yeah, no, it's a great question. Like, we published a report with Riot Platforms that had something called the Bitcoin scaling cycle in it, where we kind of go through phases to where we see a bunch of transaction fees rise, the mempool gets really blocked and bloated, and then all of a sudden people are like, oh my gosh, like Bitcoin can't scale. We need to build scaling solutions. And out of that, came most of Lightning, I guess. Exchanges started batching transactions. We got SegWit. So we got all of these liquid started to get at least developed or used a little bit. So we got these like scaling technologies that kind of came out of high fees. And then now I feel like we're kind of at the point where fees haven't been really high, at least over the last year or so, and now people are like kind of talking the other way. They're like, hey, Bitcoin security is flawed. It's scaling too well. And so it's kind of like this vicious cycle to where, okay, Bitcoin's scaling too well. then all of a sudden we have another wave of adoption, which may be maybe this year, maybe next year after the halving, when macro conditions get better and supply gets more scarce. And when adoption rises and we have the massive parabolic bull run, that's when like fees will go crazy again, because again there's a fixed amount of block space where not everyone can necessarily hold their own private keys like in the split second. And so then fees will rise again, and then all of a sudden there's going to be demand for scaling technologies again, and people are going to get really creative with whether it's with Lightning or Liquid or other things that we can't even imagine today. And so yeah, I think it's a great question. I think market forces kind of enable it to play out in a very efficient, effective way over time. There's probably pain on both sides where it's like, okay, like Bitcoin's not scaling, like we need to build some solutions, but then, those solutions inevitably will get built ideally without compromising, the important thing about Bitcoin is that like the core consensus rules are not going to be changed in any meaningful way. So yeah, I guess those are my thoughts.
Yeah, well, that's actually a really interesting point, because like everyone talks about, there's not enough of a fee rate now. Like that's what have we done so well with Lightning that we don't, that the fee rate doesn't pay the miners enough. But it's an interesting question of whether, when we have these cycles, actually, I haven't thought about this before, when we have these cycles that occur in the future as the block subsidy decreases, is there going to be a lot more pain for miners in the bear cycle than the bull cycle? But maybe the profits of the bull cycle will make up for the bear cycle. I don't know. Do you have any thoughts?
Yeah, I mean, it's a great question, right? Like miners, obviously, the mining revenue is from the block subsidy and transaction fees. So selfishly, from a miner's perspective, obviously you want both to be really high. In my opinion, even though we're going to have a halving in 2024, the price of Bitcoin is going to do a lot more than a 2x, in my opinion, from $20,000. And so the price itself is going to make up more than the decline in the block subsidy. But you're right, eventually the block subsidy is going to actually go to zero. It's kind of far away, but it's going to exponentially turn that way because it gets cut in half every 4 years. And so miners, I think, will be relying more on transaction fees. But I also think, like, as we're talking about, can Bitcoin scale or can it not scale? I think there's a fixed amount of block space. I think the most likely scenario is, hey, if we're going to onboard literally billions of people and millions of companies and potentially even governments to this technology, like there's going to be a lot of demand to settle on base layer Bitcoin. And it's going to be sizable amounts of Bitcoin. And the reality is we're probably going to see, okay, Bitcoin can't scale again, and it's going to be back to that scenario. And people that may not have much Bitcoin may very rarely settle to the base layer, or maybe we'll see a crazy scaling solution that enables them to settle to the base layer. But I think like the reality is that, hey, transaction fees are probably going to go up very significantly, over the next 10 to 20 years. And, scaling solutions will occur, but yeah, miners will be, especially, 20, 40, 50 years out, miners will be definitely relying more on transaction fees. Another thing is like miners are like diversifying their revenue at this point. Like you see Riot putting out press releases that, hey, because of the ERCOT, the way ERCOT is set up, which is the Texas electrical grid, they 1 month in July during the summer when it was really hot, they made more money not mining Bitcoin than they were mining Bitcoin. And so, and it's because of how the grid is set up, and they're basically acting as this like demand response system for the grid. So I think there's going to be a lot more miners kind of integrating with energy grids themselves, and they're kind of going to be not just making money from like mining Bitcoin and earning transaction fees, but they're going to be making money, not hashing basically. And so I think that it's going to get interesting, and I think more and more miners are going to really get involved deep within the energy industry, because I think that there's a lot of like power producers or oil and gas producers. There's a lot of excess energy that's just never used, and miners are this like time and location independent resource that could come in and operate 50% of the time. But if they're paying almost next to nothing for the energy, it makes a lot of sense to do it. So that's kind of how I think it's going to play out for miners.
Yeah, that's a really good point. And I guess the other thing we're forgetting as well is how much technology improves also over the course of the next 50, 100 years. What's the likelihood we have, I guess, a block size limit of 4 MB right now. But is it conceivable that internet speeds improve and hardware improves enough that maybe we double that? Like I'm not saying do that today. I don't want to be crucified for another block size wars, but over the next 100 years, maybe that's conceivable, and so maybe that just like lessens the burden slightly. In addition to all these scaling solutions, that we get to a point where we're at an equilibrium where we can onboard 7 billion people over the course of the next 150 years. I don't know. We'll see.
Yeah, definitely. I definitely wouldn't advocate for a block size increase right now. But yeah, no, totally agree. It's going to be very interesting to see, I guess, how it plays out. But yeah, I guess, do you guys from building AtomicFinance, do you guys know of any use cases? Are miners using AtomicFinance at all? Or I know I could probably talk about it as well, but do you guys have any users that are mining Bitcoin and maybe using your product?
Yeah, to our knowledge, there are no industrial grade miners, or there might be some folks hobbyists shops or what have you, but to our knowledge, there isn't any big miners who are using it. I think that moving forward, though, I think that it is an interesting question. We've even kind of been discussing it amongst ourselves in terms of DLCs are quite versatile in terms of the types of financial contracts or strategies that you can encode. And so, what could that look like in terms of strategies that might make sense for, say, a miner, an industrial grade miner, or entities or companies, or even countries. We see countries adopting Bitcoin, obviously. And so I think these are all really good questions. I think that certainly there's opportunities there in terms of maybe miners could use it to help part of their treasury management, for example. We know that that has traditionally been an issue for some entities in the past, and whether it's hedging price downside in a bull market to kind of cover your butt in terms of if things go the wrong way or what have you. So I think it's definitely a very interesting kind of avenue that we haven't yet explored, but that we want to explore in the future after we've kind of focused on just kind of more of a B2C approach right now in terms of your average Bitcoin holder who are our primary users of the app at the moment. But definitely a very interesting kind of space and problem space that we want to kind of explore moving forward further into the future.
Yeah, absolutely. Or Matt, did you have anything you wanted to add on?
Yeah, I was just gonna say, I was just curious from your perspective, Joe. Obviously, you guys have a lot of chat with miners a lot. I was curious, what are the biggest pain points that miners have right now in terms of treasury management? Obviously, we saw lots of miners kind of go out of business in the last year because obviously they did not have good treasury management.
Yeah, absolutely. I mean, I think it's been kind of the story of the mining industry throughout 2021, 2022, and even early 2023. A lot of people got in public corporations, private companies as well, got in very over their head, taking out ASIC collateralized loans, borrowing as much money as they possibly could, and just kind of going leveraged long Bitcoin, and especially Bitcoin mining, which is in a way a derivative of Bitcoin itself, which is potentially more return, but also more risk. And when all of this leverage piled up, a lot of people, when the price of Bitcoin didn't go the right way for their trade, obviously they got wiped out or got close to being wiped out. And so, yeah, I think this is a really interesting topic around treasury management, because I remember in 2021 you would hear all of the public miners announcing, hey, we just worked with Bitmain and we're acquiring 50,000 S19 XPs, and we bought them all on leverage or something like that. And it's okay, this is going to be crazy. You're either going to be worth $100 billion in 2 years, or you're going to be worth zero. And so It makes sense. It's very aggressive play, but high risk, high reward. So yeah, I think because there aren't $100 billion Bitcoin mining companies that exist today, not even really anywhere close to that. Treasury management and I guess operating very conservatively has become more and more paramount. And it's obvious that like, hey, if you're going to play with this thing called Bitcoin during its monetization phase, it's a very volatile asset. And if you're caught on the wrong side of the trade, you're going to get wiped out. And so I think that this is, like I said, it's a great topic around treasury management. I think something like the covered call strategy that you guys already have today would probably be pretty helpful for miners, because then they could say, hey, we want to hold, a certain amount of Bitcoin on our balance sheet. We also are probably at least selling Bitcoin to cover our operating expenses on a day-to-day or month-to-month basis. But we also want to hold Bitcoin to get that up, the potential upside exposure in the long run. But we want to kind of generate some yield off of that. So, hey, we have some extra cash flow to pay for expenses if Bitcoin, goes sideways or even trends down. So, yeah, I think it's something that a lot of miners probably would be interested in. And that's one of the reasons why I'm excited about, I guess, what you guys are building.
Yeah, definitely. I think or you could even tweak the cover call strategy a little bit, where basically it's called a collar strategy, where you sell a cover call but also buy like a put. In that case, basically, if Bitcoin keeps rising, from a miner's perspective, okay, maybe selling that cover call is a good thing and keeps me disciplined. I'm selling at a high, and then basically if it doesn't go that way and it ends up dropping quite a bit, then you still have the put that protects against downside risk. So yeah, definitely lots of kind of interesting things that we can kind of experiment with on that side of things in the future.
Yeah, definitely. I mean, that's a great idea, because a lot of mining, you can, at a certain point in time, you can look at the price of Bitcoin, you can look at hash price, you can look at your energy expenses, and be like, okay, if I could just lock in these prices over the next period, I would do pretty well. And so that's something like that where you can somewhat lock in the price of Bitcoin, at least with your treasury. I think that'd be, super helpful. I know the Luxor guys have created a hash rate derivatives marketplace where you can hedge against, difficulty increases, because that's kind of your future cash flows denominated in Bitcoin. And so, yeah, I think products like that where miners can hedge their price volatility risk are fantastic, because there is a lot of volatility in Bitcoin.
As we well know, yeah.
Yeah. I'm curious, how did you guys go about creating, so back to AtomicFinance, how did you guys go about creating the current covered call strategy? And I guess when you guys built it, how do you avoid overfitting and saying hey, we're testing it on, or training it, your model, I guess, on this previous data? How do you make sure that it's going to actually perform to similar standards in the future?
Yeah, that's a great question. So I guess first off, what is backtesting? How do you build a trading strategy? So typically what folks do is you'll come up with a certain hypothesis of here is certain conditions that we think will yield a good return trading over a certain period of time, and you'll go and you'll backtest that against historical data, say all the way back to 2012. So a super simple maybe example off the top of my head might be every time Bitcoin goes down 10%, I'm going to buy Bitcoin. And then I'm going to see, I'm going to compare that to maybe simple DCA and see, does that perform a higher P&L over the last, 10 years, for example. And so you can do that, and, that will yield a certain result. But one of the issues that might come up is what's called overfitting. What is overfitting? Overfitting is basically the idea of, if you tinker, with the parameters that you're putting into your backtest a little bit too much, then you might just happen upon a result that looks very positive, right? And so you're able to, you can put out a narrative that shows a strategy that is very, positive and yields a lot of return, but when you actually go to trade it, it does not do that. So how do you account for that? Well, there's a couple things that you can do to make sure that you're not overfitting your model. So number one is keep it simple, right? So if you're using these really complicated algorithms for generating a strategy, there's a good chance you're overfitting it. You tinkered with it so much that you resulted in a strategy that is actually not effective at all in trading. You go to trade it and it loses money. The other thing as well is to have an in and out sample, or basically like a testing part of it, and like a back testing. So two different samples in your back test. So one will be, say, if you're optimizing over a certain parameter. So say I might choose an in sample period of 2 years and an out sample of 6 months. So I go and I back test it over 2 years, maybe from 2012 to 2014, and then I go and run that the first 6 months of 2014, and I see, does it yield a positive result? So what you're doing is you're actually emulating the process of what you'd be doing by back testing and then actually trading. And so in this way, you can actually avoid overfitting significantly. So what we did is we used a combination of actually being able to use historical Bitcoin data all the way back to 2012, and using technical indicators that look at trends in the market, and basically backtested that all the way back to 2012. So we've got a model that works with Bitcoin historical data. Now options data is a little bit different. It's only been around since 2019, so around 3 years. And so then we use that model in combination with the options data to actually generate the cover call strategy. So it was using a couple of those steps to avoid overfitting and backtesting with that data that allowed us to come up with the strategy. Yeah.
Very cool. Yeah, we're kind of working on not necessarily like a trading model at Blockware, but we're working on like a hash rate and mining difficulty model to try to say like, okay, like if hash price is this and the latest generation ASIC is this, what's the hash rate going to be in 180 days or a year? So it's really cool. It's really cool that you guys have built that for actually the price of Bitcoin. Challenging, but it's very cool.
That's fascinating. Is there like technical indicators for like hash rate? I've never even looked at that. That's fascinating.
Yeah, I mean, it's like the way that we're thinking about it right now. We haven't published anything. I don't even know. So very early stages. But like the way that we're looking at it right now is like, okay, well, we know that or at least in my opinion, hash rate is a lagging indicator on the price of Bitcoin. Like when the price of Bitcoin goes up a lot, like in 2021. And mining difficulty is relatively low, everyone's like, oh my gosh, I need to mine Bitcoin. These machines are printing money. And then that leads to hash rate being built out in 2022. And so there's kind of like things like, I guess, inputs that you can look at and be like, okay, what's the latest generation ASIC at? What's hash price at? What has been the hash rate growth over the last week? What has been the hash rate growth over the last year, over the last 6 months? And then using all of that, I guess you can kind of create a model that says, okay, hash rate growth over the next month or the next 6 months is probably going to be something like X based off all of the historical data that you back tested off. So yeah, interesting, similar things that we're working on. I'm curious. I know this is kind of a different topic, and I don't even know actually how to say this term, but NOSTR or NOSTR, whichever one you call it, I'm on it. It's pretty cool. I like it. What are you guys' thoughts on NOSTR or NOSTR? How do you say it?
I have no idea the NOSTR is. I guess we should probably say, what is NOSTR? NOSTR is like, I guess, I would say decentralized Twitter, but it's probably more like distributed Twitter. A protocol. It's like a protocol that allows for folks to be able to do essentially what happens on Twitter, but from a protocol level, and people build clients on top of it. Yeah, sorry, what was your question again, Joe? I forgot the question.
All good. I guess, like, just what are your thoughts on it? I mean, like, I've been using it. I've seen some people complain that, like, the user experience isn't great. It's been mostly good for me, and it's cool to know, I guess, at least in my opinion, that, hey, like, if Twitter got shut down or, like, Bitcoin Twitter, like, everyone got censored and cut off, we kind of have this backup to where we can all go and still communicate with each other. But those are at least my thoughts. Like, what are your thoughts on NOSTR?
Well, I thought it was really cool how, Jack, who's someone who went and obviously was a co-founder of Twitter, always believed that Twitter should have been a protocol in essence from the very beginning. And I think it's very, a lot of people have said, oh, we need decentralized social media. And over the years, they've gone and they've built a blockchain around it, and which has just been, just nonsense. And so it's really refreshing to see folks come from kind of a first principles and build a protocol for how to build a distributed system, and then go and build it, and then have Lightning kind of be the native currency of that protocol. And so I think that's been really fascinating to see. It's been also really cool to see where the interest of this has come from. I think what are the popular clients right now, like Damus, Iris.to? I know Damus recently, they're really trying to get on the App Store. and they kept submitting it. So this is Damus is just a client that allows for people to use Nostra in a really simple manner. It literally looks like Twitter, and they finally got it on the App Store after multiple reviews, because Apple said, oh, you need to be able to ban people, and that's not how the protocol works. and they finally launch it, and they get 153,000 downloads in 3 days. Right, insane. And there were a lot of searches for Nostra from like China and like Hong Kong, and then it was eventually removed from the Chinese App Store. And so, it's really awesome to see like where folks are getting interested in this, and how the censorship resistance aspect is something that's really powerful and really important. I think particularly after what we just saw with the shadow banning and what's come out with the Twitter files over the past couple months. So really cool to see.
Yeah, I'm curious, are there any use cases for NOSTR and like your vision of sound finance?
Yeah, actually, it's funny. Fiat Jaff, who's one of the core developers of Nostra, he created a post the other day which was like, oh, what are all the use cases for Nostra? Like, obviously everyone's using it like Twitter right now, but one of the actual cool use cases of it is for say like Oracle announcements. So if you have like various like DLC Oracle announcements that are created, it's actually a perfect broadcasting system, because instead of you having to rely on one centralized API to be able to get that access to that, you can just use Nostra. It's also really great for marketplaces. So in the future, if you wanted to allow for, say, a distributed or decentralized exchange for, say, like options or futures contracts that is built on top of Bitcoin for using DLCs, you could also see that built on Nostra. I think a good example of this, like an alternative that's been built, is say like Join Market, which was designed for CoinJoin. Sorry, it was designed for CoinJoins, and right now they use IRC Chat, which is just, as everyone knows, is just a centralized server, and then they have backups that they can go to. But if you use something like Nostra, you can actually get that kind of broadcast in a much more distributed manner without kind of relying on one server. So lots of different applications for sound finance for Nostra for sure in the future.
Awesome. Yeah, it's great to hear. I didn't think about those specific applications. Last question, then we can go ahead and wrap it up. This was a super awesome conversation. What is your vision for Bitcoin in the next 20 years? Like, we talked about sound finance and I guess doing like financial transactions using Bitcoin base layer or on Lightning, but like, how do you envision Bitcoin and like the world as a whole in 20 years?
Yeah, I think like, maybe I have like slightly controversial opinion, but I think that, it's not necessarily inevitable just yet that Bitcoin is going to become this world reserve currency. I think there's quite a bit of work between now and then that we still have to work on, whether that's, fundamental, simple stuff like bringing more builders, attracting more builders to work on Bitcoin, whether that's things like even like educating politicians to kind of help them understand the benefits of Bitcoin more, and of course building more on-ramps and aiding adoption. But of course, like, for us, like what we're focused on is, building tools such that if folks want to do so, they can actually use their Bitcoin with financial tools in in a self-sovereign way. I think that like, in 20 years, hopefully, like what we'll get to see is a thriving ecosystem of different like kind of layers built on top of Bitcoin, where like the underlying consensus rules of the base layer is obviously for a specific purpose, maybe for specific larger scale transactions and settlements, but then you have different layers built on top of Bitcoin that can kind of like be for specific purposes and use cases, and maybe there's one layer there for sound finance and different finance show tools on Bitcoin as well. And so that's kind of how I see it. Lots of work still to get to that point, but I think that Bitcoin community out there is a very diverse group of people who are working on many of these different aspects, and so definitely very kind of like encouraged by all the development and all the builders on Bitcoin. And so yeah, excited to kind of like be part of that journey and hopefully help Bitcoin move closer to become a world reserve asset. Matt?
Yeah, that's a good question. Let me think. It's going to zero. No, just kidding. Well, if an asteroid hits the Earth, probably going to zero. But if an asteroid doesn't hit the Earth in the next
or a
20
UFO
years,
invasion, I guess.
Okay, yeah, one of the two, you know. So if those two things don't happen, then I think, I agree with Tony that the default for Bitcoin is not immediate success, right? There's, there's not enough space on chain for 7 billion people to use Bitcoin today. And so some changes need to be made, not huge changes, because that's going to destroy the entire incentive system that we've built up. And so some changes need to be made to allow for, Bitcoin to scale in the long term. But I don't think that's good. Probably not going to be that big of an issue for the next 20 years. I think probably Lightning. And I think another question too is, what's the biggest risk to Bitcoin? The biggest risk to Bitcoin is politicians having proper fiscal monetary policy, right? And so what's the likelihood of that happening? Well, that's probably pretty low. And so depending on how badly also other fiat currencies do, I think that's also going to influence what happens for Bitcoin. But I think in general, there's going to be a lot of opportunity for countries around the world that typically have had a very terrible, a monetary system and hyperinflation that is occurring, for them to have the opportunity to go and actually adopt Bitcoin like we've seen in El Salvador. Maybe lots of South American countries in Africa, Turkey are going to have Bitcoin as legal tender in the next 20 years. And I think that's going to be really the bull case for Bitcoin, and having this decentralized money that allows for that to occur. And also for it, maybe in 20 years, like Bitcoin is the standard internet money. You don't, instead of using a typical credit card, you're usually paying using Lightning Network. Maybe that's what we see in 20 years. So that's what I'm hopeful for. I think we need to do the work to get there. I think we need to make sure that Bitcoin scales, and let's roll up our sleeves and let's make sure that happens. So yeah.
Yeah, I think that was.
How about you, Joe?
Yeah, I think both of those were really well said. I mean, I'm definitely very bullish on Bitcoin. I don't think Bitcoin's perfect by any means. I don't think anything is really perfect by definition, but I think it's simply the least uncertain asset there is. And I think because of that, 10 years from now, 15, 20 years from now, there's still going to be only 21 million Bitcoin. That's not going to change. It's very hard for anyone really, or any group of people really, to ever change that. And I think because of that, it's just going to be simply the least uncertain asset. More people are going to adopt it over time. We're going to continue to have a halving roughly every 4 years, where the supply gets more scarce, and all of a sudden miners are selling less coins than they were the previous 4 years. And so, yeah, I think that over time, adoption grows and it doesn't break, basically. And because of that, I think that's going to be good for Bitcoin. So yeah, I think it's interesting to think about the long-term future of Bitcoin for sure. But we'll go ahead and wrap this up. I'm curious, where can the audience find you guys and what you're building after they listen to this episode?
Yeah, absolutely. You can check it out. If you on Twitter, we're at AtomicFinance, or our website, atomic.finance. And you can find myself and Tony on Twitter as well. I think at Tony Kai and at Matt13Black. Yeah.
Awesome. Sounds great. Well, enjoyed it, guys. Glad we could have you on the podcast.